I will be talking about some introduction to reading financial statements and understanding financial ratios. And yeah, just a disclaimer. I am showing this because the following information that I'm going to present for today's session is purely based on my experience and what I know, and do not treat this as a professional financial advice. And just to share that investing is risky and due diligence will be required. And please treat this sharing as a form of education or entertainment. All right, so let's dive into today's session. And for today's agenda, there will be three. I will share the structure and also relevant elements of the financial statements as my first agenda item. And for the second, I will be talking about some examples of important financial ratios for fundamental analysis. And then the third item would be some activity based on some of the annual reports or financial statements that I've extracted from the internet. All right. So for financial statements, if you all would know, every public listed company will need to produce an annual report. Of course, they would also report on a quarterly basis on their financial numbers. And typically, in a set of financial statements, right, it will require the submission or the inclusion of three sub-reports, which would include the income statement. And for the income statement, we are going to talk about revenue, expenses, as well as profits. Okay, so in this statement itself, it will include these three key components. Okay, so in the second piece of these financial statements would be the balance sheet. Okay, this balance sheet will include assets, liabilities, and equity. Okay, so for liabilities, basically it means borrowings or loans or debts, right? Equity would be what is being retained within the company itself. Okay, so that's called the balance sheet. The last item would be the cash flow statement, which will include operating, investing, financing, as well as cash and cash equivalents. Okay, I will share more about it later in my presentation. And last but not least, for the purpose of this presentation, I've used Capital Land's 2023 annual report as an example. Okay, so for the first item on this presentation, I would first talk about income statement. So just to share a basic accounting term, right, which is this bracket versus no bracket. So anyone knows the difference between the numbers with bracket and numbers without bracket? Anyone? Okay, so for the bracket one, it means it's negative or it's a loss. Okay, so you can see that the one without the bracket would be something that's positive, and also I won't say it's profit lah, but it's a plus it's not negative, right? So in terms of revenue over here, you can see at the first line item is 2784 million, right? There is no bracket to it, so it means it's positive. Okay, that means something you can bring in. But cost of sales, because it's a cost, right? So it's negative, right? So usually what we can also see is that at the end of this screenshot, right, you can see under profit for the year, if it's something that is bracket, it would mean that it's a loss, not a profit, right? But if this number 333 is a positive number, of course, then it's a profit, not a loss. Okay, so simple as that. In terms of this income statement, there will be revenue, which is you can see at the first line item. So this would mean this would also refer to the money generated from the normal business operations. And for gross profit, we are looking at revenue minus cost of sales, okay, which is 1260. And profit before tax, which is also known as EBITDA. Okay, earnings before interest, tax, depreciation, and amortization, right? So this is something that we look at in terms of profit before tax. Okay, and profit for the year is also known as net profit lah, which is this number 333 over here. Okay, so at this point in time, I just want to ask the audience, anyone would like to know or what else can you learn, apart from the key line items or terms that I've mentioned just now. Okay, so I think one thing that we can understand from reading financial statements, like what I mentioned just now at the agenda slide, is about financial ratio, right? For those who are more inclined to maths, we know that division is always numerator over denominator. So basically, ratio has the same effect as well. What we always want to know is in investment, right? The denominator is important because the numerator will tell us what is the outcome or the output or the final impact from the overall business operations, right? So for example, let's say we want to calculate cost over revenue. What does it actually mean, right? We always know that denominator it's something that we always want to know. For example, in this case, cost over revenue, revenue is the denominator. So revenue as the denominator means what is the per dollar cost that I bring in into the company, and the numerator here is cost, right? So cost over revenue per dollar. That means how much am I paying for every dollar that I bring in? So if this particular ratio is of a high value, right? So what does it mean? That means your cost of making your products or your services is very high, over per $1 of revenue that you bring in, right? So as a CEO or the CFO will then advise the CEO that, oh, there's a trend that the cost over revenue ratio is increasing. So my suggestion to the CEO is to try to look at cost cutting measures or trying to improve productivity or efficiency of our operations to create our products or services. Right. So that is one way that we can look at it. Another thing that you can also derive from the income statement listed over here is, for example, we always want to compare, right? Compare between year over year or year on year, right? So in this case, what we can see here is the performance, the financial performance or the income statement performance of 2 years, 2022, right, on the right column, and then the left column would be 2023, right? So let's put our attention to this particular line item called administrative expenses, right? So usually for administrative expenses is salary of the staff, right? So you can see that in 2022, CapitaLand paid out 490 million to all the staff within the CapitaLand group in 2022. Okay. In 2023, what do you see over here? 498, right? So there's an increase in 8 million of administrative expenses. Okay. So I think in the backdrop of the entire quantum, 8 million is not a very significant increase lah. But that would actually shed some light on the administrative expenses trending from last year to this year, right? Uh, so what I'm trying to show here is we always want to compare. That's why in a standard income statement, you would usually see 2 years of performance. Sometimes they would also show quarter to quarter performance. But in this case, we are comparing year versus year. Okay. Right. So at the last part of this income statement, it shows something called the EPS, right? So EPS stands for earnings per share, right? So earnings refer to profit. Okay, I repeat, earnings refer to profit, right? So earnings per share means the total profit divided by the total number of shares that are reserved inside the company. Okay, I repeat, earnings per share means the total profit for the year divided by the total shares in the company. Okay, EPS is very important. As you can see over here, if you refer back to point B about year versus year, so what you can see here for the EPS, anyone want to hazard a guess? We compare year 2022 to year 2023. What happened to the EPS?
Dropped a lot, right? Because of interest rate.
Exactly, right? So it dropped a lot, right? From 16.8 or 16.5 cents in year 2022, it dropped to 3.5. Okay, so I can quite conclusively say that there will be an impact to the share price because the share price is actually driven by the earnings of companies. So I'm quite sure that CapitaLand won't be performing well in terms of share price at least for last year. Okay, and also possibly this year because this is for FY 2023. Okay, so I will move on to the next item, which is the balance sheet. Okay, so balance sheet over here you can see quite clear cut, right, and straightforward is that it comprises asset, liabilities, and then lastly equity. Okay, so just to share some definition, for non-current assets, it is something that cannot be liquidated in the short term. Okay, in the short term refers to within a year, right? And for current assets, it can be liquidated within the short term. That means within a year. And for non-current liabilities, they are the debt that is in the long term, and current liabilities will be the debt in the short term. Okay, so the net assets is also equivalent to the total equity within the company. And just remember this very important and simple equation, which is assets minus liability is equals to equity. A minus L equals to E. So you just remember ale, the ginger ale, ALE. A minus L equals to E. Okay, so this is a very important and simple equation for us to remember. Okay, so with this, right, balance sheet actually gives a snapshot of how much valuation we can actually provide for the company because I know what is their capital equipment value, which is the non-current assets. So in the case of CapitaLand, right, what is their main area of business? Anyone?
Building property.
Yeah, real estate, right?
Yeah, real estate.
Property, yeah.
Yep. Yes, correct. So, property, are they long term or short term? Are they cash or
Long term, long
something?
term.
Long term, right? Yeah. So you can see that in fact for their long term asset, which is the non-current assets, the value is extremely high. Which is a total of 29 about 30 million 30 billion. Okay, because this is 30,000 million, which is 30 billion, as compared to the current assets. So current assets, you can think of it like liquid cash, right? So you just need to understand non-current and current. What are the differences, right? For liabilities, of course, they are just borrowings, right? Whether they launch their own bonds, which are long term, I guess you all would probably have heard of those retail bonds by companies. So they actually can launch bonds as part of a fundraising exercise for them to have more cash within the company. Okay, and equity is basically what is retained within the company itself. All right, so that's for balance sheet. Lastly would be the cash flow statement. So okay, so this is a bit wordy, But also a very important thing to note within the financial statements, because if you all know, for Warren Buffett, he always uses the idea of free cash flow to also evaluate these companies that he wants to buy, right? So free cash flow is very important because it helps us have an idea to know whether this company is a cash generation machine or not. Okay. So for cash flow statement, there are a couple of sections that you need to pay attention to. So firstly, would be the cash flows from the operating activities, which is also the cash gained or used from the operations. Okay, so you will look at the net, cash flow from ops activities over here, and the net cash will actually show you whether the operations are actually making money or not. Okay, so over here you can see that it's a positive value. Okay, at the bottom, right? And the next one would be the investing activities. Okay, which is the cash gained or used from capital expenditure. Right? And you can see that it's a negative net cash, so it's not not making money in that sense. Okay, financing would be the cash gained or used from loans or borrowings. Okay, so this is a negative over here. Okay, and eventually, for me lah, this is something that I also want to highlight to everyone. For their knowledge, is that cash and cash equivalents or C, usually they also can represent as C/CE, right? So this is in fact what is the amount of cash being held within the company itself. So you imagine this like a wallet lah, right? Or a vault, right? Within the company. So in this case, we are looking at about 2.4 billion, for capital land in their pockets that they can deploy in terms of cash. Okay, so this is basically the summary of the cash flow statement.
Wait, just a quick one. So actually, if
Yeah.
you look at the 2022, 2023, what's the main? Tell me, what's the main thing you look for when you want to decide to buy? Because I see like it's quite not much difference in terms of not much significant difference. Besides
So
this,
so you can see, right? In terms of the operating cash flow, not much of a difference, but there's
yeah,
a slight dip. Okay. So for investing activities, there is somewhat an improvement, right? About half, 50% improvement. Okay. And then for financing, it actually reduced the debt, which is good, right? So the cash flow from operating activities is a slight dip, but I think it's not extremely concerning. It's still positive, right? Investing activities got better by 50%. And in terms of the borrowings, it actually reduced by also half. So these are positive in a sense, right? Then when I look at the cash and cash equivalent, it's a slight dip, but nothing to be overly concerned, right, at this point in time. Yeah, so that's how we read this. Okay. Right. So I've completed the three elements of the financial statements. So we spoke about the income statement, right? Balance sheet, and also the cash flow statement. I'll move on now to this section, the second part of my presentation on the financial ratios, and what are the formula that you can calculate based on what you see within the set of financial statements in order for you to derive the financial ratios. Okay. So for financial ratios, typically there are six categories as listed over here. So firstly is liquidity, profitability, return on investment, efficiency, leverage or debt, and then cash flow. Okay, and these ratios offer you insights to how the company utilizes, earns, and owes money. Okay, and from my personal experience, I don't use all the ratios listed over here. Later I will show you some of the examples of the ratios which I use to help me or facilitate my decision making in buying the company shares or not. Okay, and one more thing that I just want to let you all know, is to beware of paralysis from analysis, right? Because I rarely see a company doing very well in all the stated ratios, right? So that's why I only pick and choose some relevant ratios which I feel is important. Then based on that ratio, I will make a judgment. Okay. So that's why my recommendation and suggestion is to select relevant ratios, and then you can test it out, some combination or permutation which will work for you. Okay. So I just want to explain for the various categories of financial ratios on this table. So firstly, for liquidity, right? To make it liquid means the ability for you or for the company to pay off their debts. Okay, and for this section, I usually use the current ratio, which is using current assets over current liabilities. Okay, the formula for current ratio is current assets over current liabilities. Right? So this particular financial ratio means how much assets I have in order for us or for the company to pay off their debts within a short period of time of 1 year, because it's current. Okay. So my question to you all is, current assets and current liabilities, they come from which part of the financial statement? Anyone? It comes from the balance sheet, right?
Yeah.
Okay. Yeah, comes from the balance sheet because assets and liabilities, right? A minus L equals to E. Okay, right. Okay, then I'll move on to the next section, which is profitability. Of course, it means the ability for the company to earn profits, right? So this is a very straightforward section, and usually what I look would be the net profit, because simply this is actually something that they earn at the end, right? Which is the profit at the end. So clearly, if it's a loss-making company, then I don't really want to look at it, right? But of course, a lot of startup companies, they lose money at the start. So we call them the growth companies. But if we do fundamental analysis, these are loss-making companies with very poor cash flow generation model, right? So as fundamental analysts, we usually, like for myself, okay, for myself, I won't look at it. But if you all are, wanting to venture into this kind of high growth, high risk kind of companies, of course, risk and reward, they are twins. So high risk would mean a high reward. So if you all want to invest in startup companies, there's a different set of considerations that you should look at. Right, but definitely not fundamental analysis or value investing. Okay, so that is another topic altogether. But for me, I will look at net profit margin. But at the same time, like what I also shared just now, I do comparison year on year. Okay, for some of the key indicators listed inside the particular statement. Okay. Return on investment would mean the ability to earn profits per dollar spent. So this is something that we usually look at. And ROE right? Return on equity is something that we usually will look at, or ROI in a sense, right? They refer to similar things. So net income over shareholders equity. Okay, so these spans across the two statements, right? Right, the income statement and then also the balance sheet. Okay, so efficiency means the ability to efficiently churn sales, right? And this ROA is something that we usually will look at in terms of looking at efficiency. Financial leverage is how much money the company owed. So I usually look at these two. So total debt over total assets. So you can see the financial ratios are quite dynamic because it's just a matter of changing the numerator and denominator. So if I take assets over debt, that is like similar to the current ratio, right? So which is the ability for my assets to pay off all the total debts. Okay. And then I also will look at the DE ratio, which is called the debt to equity ratio. So this is also just an indication of how much debt that I need to pay off with the net equity that I have within the company. Okay, and last but not least will be cash flow. So it's the ability to generate cash. And what we can see over here is the operating cash flow ratio, where we look at the cash flow from operations, which I shared with you in the cash flow statement, over the current liabilities using the balance sheet. Okay. So one bonus formula that I've listed over here is known as the free cash flow, right? Also known as a FCF. So this is basically the cash flow from operations minus off the cash flow from investing. Okay, so if it's a positive and it's a high positive as compared to purely the cash flow from operations, then it's something that we will look at the company quite favorably. Okay, so there are other financial ratios which are not listed in this in the previous table, and just want to share with you over here. So there are three in total. So in terms of valuation ratios, right? I guess this is something quite common to everyone, and it's called the PE ratio or PER. Okay, so if you all remember right at the start when we talk about the income statement, I spoke about EPS, right? This is the point where I want to share about EPS. So price refers to the share price at the moment you check, right? So the price refers to the share price. Okay, it is fluctuating for sure, right? But this would actually provide you the PER, which is whether the price of the share is expensive or not. Okay, I repeat, PE ratio or PER refers to a multiplier or multiple that tells you whether the share price is expensive or not. Okay, and the typical range, okay, the typical range of whether to evaluate this share price is expensive or not, right, is like 15x to 20x and above. Okay, so above 15x or 20x, it's considered expensive. But I just want to caveat, it depends on the industry also. Okay, so if you look at Nvidia now, or AWS, their PE is extremely high. Okay, but it's supported by a lot of cash in their company because they are definitely cash generating. But at the same time, there's a lot of hype, that is built into this the price. Okay, the stock price. Okay, so a lot of euphoria, and therefore it drives the price very high, and therefore the PE ratio is probably in the hundreds. Okay, so it really depends on the industry as well. Okay, I can talk about how to do benchmarking and also evaluating whether the company is expensive or not in another session. But just simply for the knowledge of PE ratio, right, is basically whether to assess or evaluate whether the share price is expensive or not. And if it's more than 15x or 20x, it is considered expensive. Okay. The next valuation metric that I want to talk about is price to book ratio or PB ratio or PBR. Okay, so this is a simple formula that I use, which is the share price over total assets. Okay, the more rigorous one is tangible asset, because tangible assets means things that you can sell, right? But I mean, just an interesting fact to share with you all, right? So in the balance sheet for particular companies, there will be this line item called intangible assets. Okay, intangible assets. Can you all suggest what does intangible asset means? Anyone? Intangible. Oh, but intangible means cannot touch. That means it's virtual, right? Tangible means you can
IP,
see.
is it?
Yeah, yeah. Okay, IP, right? And also another one which is called brand. The brand.
Yeah, brand.
Okay, intangible assets. So the brand can be used to make money, right? So yeah, so these are intangible assets. But typically for this price to book ratio, we usually use in industries that are related to hardware lah. That means properties, I would use PB. REITs, I will use PB. Right? Anything that involves as that means huge capex, I will use price to book ratio. Because like construction, I will use PB also. Right? But for IT, no, because I don't really use PB because they are very asset light and they are more services in nature. So I won't use PB ratio to assess IT or asset like companies. Okay. And yeah, so I will go on to the last metric on liquidity, which is the dividend yield. Okay, so dividend yield is something that is loved by many Singaporeans, right? So that's why we are more or less a dividend market, and you can see based on our STI, a lot of the companies are dividend distributing companies. So yeah, right, yes, right, banks, right? Yeah. So yeah, so for dividend yield, the formula is distribution per unit over the price. So for REITs, they 90% of their income must be distributed because that is enabling them to be tax free. Okay. So for REITs, my own personal preference is it must pay out at least 6%. Okay. Minimally, I would prefer at least 5%. But to me, it's a bit too low because the risk-free rate for Singapore is like the SA, right, which is 4%. So any other investment must beat 4%. Okay. So my preference for REITs, right, is always to be 6% and above in order for me to feel that it's a worthy investment, right? And if you can see this formula, distribution per unit over price, right? Which which do you think, I mean, in terms of the numerator and denominator, which one you have greater control? Anyone? Distribution per unit versus price.
How much
That
you,
means
you own? How much share you own?
That means how much control do you have in order to decide? That means do you decide on the distribution or you decide to go into the price? Which one you have more decision or control? Distribution or price?
Of course, the important thing is the price, because the distribution will be based on,
The company's decision, right?
yes, and also the
Yes.
the price, yeah.
No. So what you have control in terms of dividend yield is actually the price, because you decide when
When
to
do you want to go
enter.
in? Oh? Yeah, lor.
Yeah, right. So you can see from this formula, right? What you can do is to look at what is the best price for you to enter for that particular stock or share.
Oh,
And based on my past experience, my dividend yield can go beyond 10%. Why?
oh, wow.
Yeah, it's
What you
everyone,
buy?
anyone can do it. Okay, anyone can do it. But the question,
Because there's
how to do it?
Do you include capital appreciation? No.
No. Purely
Just
dividend yield. Purely dividend yield.
You buy at their IPO.
Yes, that's one factor. Buy at their low. So what I did previously is that during the when the stock prices are down, the recession fears, price are depressed. But actually, does it I mean, in terms of their assets, what is the impact? So
Temporary.
particularly, it's temporary because like for example, REITs, right? Let us talk about, let's say, the Mapletree commercial REIT. They have VivoCity.
Yes.
I ask you, during recession, do you see tenants or shops being closed down or not?
It's possible.
Possible, but is it significant? Is it like 20% or
Actually,
10?
No, like actually for Singapore, I think for commercial it was not too bad, because I think our government will give some grants for their rent, right? Then yeah, so it's more stable here. But then again, the commercial arm of Mapletree, I think it got affected from
The officers,
Hong Kong
Yeah.
and officers also, yeah.
Yep. Yeah, but what I'm driving at is that actually their assets is still there, is functioning.
Yes.
It's not destroyed,
Mm.
right? It's still there, right? But because of a momentary kind of fear or recession, right? Then the share price starts to drop because of tenancy,
Yes.
right? And people not going back to offices, so the rentals are depressed. But what happens when the economy picks up, right? So we must be aware that distribution per unit, right, is based on the performance of the REIT or the company's ability to have net profits, because they pay out through the net profits, for the dividends, right? Yeah. So this is very important. And therefore, if you buy the price at the low, even though their distribution per unit at that point in time is reduced, okay? If you buy the price at the low, when the economy picks up, right, from a 4 or 5% distribution per unit at that point of entry, right, until the economy picks up, you can even hit more than 10%. Because the price you enter is the most important. Okay?
Yes.
So I repeat, the price that you enter is very, very important.
Yes.
When I started, it was during the financial crisis, right? So at that point in time, we are talking about DBS, UOB, OCBC, they are all single digit. Single digit. Okay, I remember OCBC was $4 plus. Okay, you imagine if I go in all in at that point in time versus now.
You reach already,
you can retire, right? So that's why this is the learning point that I want to let you all know. Always buy in at the low, because the entry price determines everything, right? So now like DBS, they are paying out in terms of dividend yield like 5 point something percent or 6%, right? You imagine when you entered at a single digit, wow, I tell you, it's marvelous. Right?
Marvelous, yes, very
Yeah.
marvelous.
Yeah. So always don't be fearful of retracement. Okay, if the markets go down, I think a lot of people are fearful, but we must always think contrarian. Right? Contrarian means opposite. Right? That's of course like what Warren Buffett also said, right? Be greedy when others are fearful, but it's hard to practice when times are fearful, lah, right? If everyone is scared, you will be scared also, lah, because that's emotions, right? Right, and the tendency for people to sell their stocks, right, during periods of crisis is quite high also for whatever reason. Because to me it's irrational, right? You sell at low period, which is it doesn't make sense to me. So I buy at the bad period, right? So always remember that, right? So like the recent July or early August period where there was a retracement, right? The S&P, the S&P, Nasdaq, they all went down. Singapore also went down, right? DBS, I think I remembered replying someone can look at DBS, right? Because it went down quite a bit, right? So I went in at that point in time. So luckily it was a V-shaped recovery, if you all saw the chart for S&P.
Gary, why didn't you what makes you think that it wouldn't like go down a little bit further? Or
Okay.
you would just buy in trenches? You know what I mean?
Yeah. My idea was buying in trenches. My idea was buying that. I'm not going all in at that point in time. So okay, so there are two schools of thoughts lah. So in my first session, I did share that one of the earlier books I read was Adam Khoo's book, right? So he is a proponent of buying in when the market shows signs of recovery. That means you go down, you don't catch a falling knife, right? You only buy in when you see there is a good momentum of the share price going up. Then you have a level of certainty that this is the recovery phase, right? But to be honest, I was there before. I can't I can't see because these are all done in retrospect. Okay, we always have the benefit of hindsight. So it's easy to say that once you hit the so-called bottom and it's going up a bit, right? How can you be so sure there is no dead cat bounce? It's hard to say that it is a recovery phase, right? So that is Adam Khoo's perspective. But if you all know Mr. Lu Ching Chuan, right? We call him Mr. CPF. During the 2022 period of high inflation, he kept buying down. Okay, that means this is what they say. Why are you catching a falling knife? But the thing is that his point of view is, when do you know the bottom is there? Because no one knows when is the bottom. It's almost impossible to time the market, right? But what is important is to be in the market, right? In the market is important because you will be already inside the market to also enjoy the benefits when there is a recovery. Okay, so he is a proponent of buying down, but of course there is a risk to it because there may be limitless downward kind of pressure. Yeah. So it really depends. But we all know that based on our COVID experience, based on our high inflation experience, based on the recent retracement, it is always a rebound. There will always be rebound unless you are talking about picking a specific company or stocks. Okay, I must caveat this. If you are buying index, so that's why just now what I mentioned, they are all index funds or ETF. Okay, indexes will never fail because they are self-cleansing. When I say S&P 500 means the top 500 companies in the US, and there's this company that is passively managing these index funds. So they say they will look at all the companies and then say, okay, this this company should go into my fund. That company not performing well goes out. Right. So I can say with confidence that for all index funds, it will eventually bounce because we are talking about the top companies,
Yeah.
Yeah.
right?
Mm.
But what if it is like high flux? If you buy into a single company, how can we be so sure that they will bounce back,
Mm.
right? So that is another way of thinking lah. Because unless can we safely say that banks will always be the most profitable trade that you ever take, highest dividend you ever get? May not be, because look at StarHub, look at M1, look at Singtel. Did they fly with so many telcos providers now? They didn't fly what? Their prices are like the same, right? What about SPH? People think that SPH blue chip, right? Blue chip. Wow, how many years of existence already? But in the end, we all know what happened to SPH lah, right? So banks, I think they have their place because one good thing is that they have a very strong moat, which is they must be licensed by MAS to operate as a bank. But do you know recently they gave out digital bank licenses?
Yeah.
Right. So
like
will that be
Mm.
a potential disruptor in the financial industry? And there are so many fintech coming up, right? So a lot of mobile trading platform has overtaken the brokerage services by our traditional banks, right? So think about it. There will likely be a disruptor in any industry lah. So I will not focus. I will avoid buying a single stock. My preference is to go onto the index investing. I'm more comfortable with that. Yeah. Okay. Right. So yeah, this is the dividend yield. So always enter at the right price. Then you can enjoy more than 10% of dividend yield at any point in time when the economy picks up.
But some stocks don't fluctuate much. Shares like SGX, SGX.
Yep.
And also Viacom. Viacom also
Okay.
don't fluctuate much.
Yeah. So if you know their business, right? SGX, okay, that's why I think I told Dennis before. SGX is not an excellent stock market or an excellent exchange, right? For many years, STI has been fluctuating 3,000 to 3,004 for years already, right? There is no quantum increase in terms of the stock index, right? You are not seeing stocks having stock prices like in the hundreds. So, and the lack of IPOs in the pipeline also impact it also impacts SGX. So the SGX can only operate or create new businesses or create new value within their current scope. So they always bring in I think recently some Thai stocks warrants or something like that. And I mean, it's nothing new. It's just structured products. It's structured financial products, right? So they can only play within their current field. Nothing. No big or significant increase in the number of companies that are being public listed or getting extremely excellent earnings.
Right.
Hardly lah, right? So that's why it's very depressed. Vicom you know like it's
It's
only car repair is like how many cars in Singapore?
It's about the
It's like
number
we
of
got
cars. Yeah, correct.
yeah. So we need to know their businesses. Yeah, in order to understand why their shares or performance is like that. Because if there is a COE, right, you will always have a relatively stable number of cars. Yeah. So that is the reality in Singapore.
I think the VCOM, the good thing is the dividend. If I'm not wrong, the dividend quite.
Oh yeah, talking about that, right? What I can say is companies with a good dividend payout, right? Generally, in terms of the stock price, wouldn't have stellar earnings one.
Correct.
Because for dividend yield, what they do, like what I said, the money,
Yeah,
the money
Mm.
and a
Mm.
significant portion of their money
Yeah.
is dividend is used for dividend payouts. But growth companies, on the other hand, they use all the money they have earned to deploy back to their business in order to reach the scale and spread, in order for them to build those humongous businesses. Right. So if you are into dividend, right, I mean, you just need to be prepared that the stock wouldn't have excellent increase or drastic increase in terms of their stock prices one.
Mm.
Right? Because their money, a significant portion is being distributed to the shareholders.
Mm.
Okay.
So you don't hold a proportion of all these stable kind of stocks in your portfolio, lah. I mean, at least a small percentage for stability diversification.
Yep. So
You
at the start of my investing journey, I love REITs a lot because I am thinking, hey, REITs there's room for capital appreciation, and also there's dividend yield. It's best of both worlds, right?
correct. Yeah.
Yep. So like wow, I mean I have a Mapletree Industrial Trust with me. I bought it during IPO. It was 96 cents. So you roughly know, yeah, 96 cents. Now it's like $2, right? So it's capital appreciation, but at the same time, I mean, this is one of the shares that I got more than 10% dividend yield, right? So that is Mapletree. But how many maple trees are there, right? So I still like REITs, but my preference is into US index now lah, because they have greater and more positive trajectory moving forward as compared to Singapore. Yeah, I mean Singapore is less exciting, but I mean it's okay if you want stable returns. I was recently looking at SYFE. I don't know if you all know SYFE. Yeah, I was looking at their REIT Plus portfolio. Like what I said, I prefer not to go into one stock because last time I had this CDL Hospitality Trust. I'm not sure if you all know. Yeah, so it's some kind of a REIT. It suffered during the high inflation. No, COVID is okay, but the high inflation period. So I bought it at 175, Now $1.75. So now I mean for years I've been having capital appreciation. I think it went up to $2 plus before. And then the dividend yield was about 5 to 6%. Right. But now because of the high inflation period, the interest rate, okay, everything plunged. Right? Remember, if those people having REITs all plunged, right? So now it's very bad.
I
Right?
think
So
I agree with you, but I think moving forward, right, with the Feds having a speech this week, as long as there's more reduction in interest rate, I think the REIT segment will see quite a huge.
we will need to see. We will need to see because it doesn't mean that when the rate reduces, then our share price will increase. Right? Because we need to know that there is a difference between interest rate and share price, because share price is a matter of demand and supply. Yeah, it's not a reflection of how much borrowing or debt that the company or REIT is having. So share price is driven by earnings and is supply and demand, right? If there is no demand, there is no supply. So if there's no demand, means our share price will be depressed for a prolonged period of time. Even correct. So we always need to rely on earnings. Okay, so that is something that we need to consider. So I think it's a good sign that interest rate is going to go down in September, but it waits to be seen in terms of the share price performance. Yeah. Okay. Yeah. So before I end this slide, right, define good versus bad. Like what I mentioned, I think I will talk about benchmarking because it's hard to say good or bad. Like we always need to compare apples to apples, not apples to orange, right? So I think in another session I will talk about industry benchmarking and what are the things that we should look out for in some of the key industries that we as investors would look at. Okay, I know we are a bit short of time, so I think I will just share the answers lah immediately. Okay, so for this company, right, are you all familiar? NKE, Nike. Okay, so Nike is a sports apparel company listed in the New York Stock Exchange. Okay, so what I've extracted over here is their income statement, right? So I just want to ask you all what is the calculation for gross profit margin? Okay, margin means percentage lah. So what I will do is that basically I will use the gross profit, which is 22887, okay, divided by 51,362 over here. Okay. So just to let you know, in this income statement, it shows in millions, right? But do you write the 6 other zeros or not? You don't, because it doesn't matter, right? Unless it states in some part of this statement that is less than 1 mil, okay, which is like the EPS, it's not 1 mil, of course, it's by dollar, okay. So you don't need to look at the 6 zeros behind. So you just basically take 22887 divided by 51,362, right? This is the gross profit margin, which is not bad, 44.5%. But do I stop there? No, right? No. I will then use my favorite number, which is net profit, right? Then I will see what is the net profit. So the net profit is 5.7 billion or 5,700 over here. I divided by the income. What happens? You like the percentage over here? The number from 44.5 to 11.1.
No, a lot of them.
No. Yeah, so what happened in between? Right?
Yeah.
So you can see that, what are the cost drivers that causing it to have such a reduced number from 44.5 to 11.1. But if I just look at 11.1% of net profit margin, I quite happy lah. 11.1% is quite decent, right? If your investment returns is like 11.1, quite good lah, right? But in the context of this entire business, right, from a gross profit of 44.5 to 11.1, then we need to investigate what happens, right? You can see that, what is the increase in terms of the various line items as listed over here, and then we can see if there's any trending. But I mean, one look, there is not much of a difference. Basically, they are just very heavy in their operating expenses. Yeah. Okay. Then what is the EPS earnings per share if the is a PE ratio? What is the PE ratio if the share price is $80 US dollar, right? So what you would do is that you take 3.76, okay, as the denominator, with the share price as 80, then you will get 21.3 x. So anyone can tell me whether 21.3x is expensive or not?
Yeah, just now you say above 15 is considered Expensive.
But what you need to do in terms of the next step before you derive this conclusion? What I will do is 21.3x first glance, right, is expensive. But I will check Under Armour.
Or you check other
I
benchmark.
will check Lululemon. I will check Adidas. Right? That's called benchmarking. Then I can conclusively say that, okay, 21.3 is expensive. But of course, I need to check first. Okay? So this is how we should do fundamental analysis. Okay, so this is Petronas. Okay, Petronas Gas listed in a KL Stock Exchange. So this is just to demonstrate how you calculate the current ratio. So current ratio, just look at current, right? So current assets over current liabilities. Okay, so current assets listed over here 305,788, and then current liabilities 93,951. So what can you derive or what can you conclude from this 3.25x? Good or bad? Remember the formula? Current assets over current liabilities. Is this good? 3.25x? It's good. Why? Because for every $3.25 of asset, I use it with a leverage of $1 only. That means for every $1 of borrowing, I get 3.25 of liquid assets. Good one. But what if your current ratio is 0.8?
Means you for every dollar you only get back 0.8.
Yeah,
Right.
which is bad, right? That means
You're
for
losing
every
money.
dollar of borrowing, I only get 80 cents. So very bad, right? So that's how you read it. And the next one is debt equity ratio, because usually I will look at current ratio first. If it's to me, if it's 1.5 and above or 1.4, I can move on to the next step. Right? But if it's not 1.4 or 1.5, I don't even look at it already. Because I need to know it has good cash liquidity inside, right? So debt equity ratio would be the amount of debt to long-term debt to equity. So 0.54, do you think is good? To me, not very good. Okay, not very
That
good.
means what? Means like every dollar of our share.
Basically, you are 54% leverage. That means you think about it, like your half of your income is used to pay debts. Right? I mean, they're not really income. Yeah. So for this DE ratio, I would look at 20 to 30%.
20 to 30.
Right. So you think about REITs, they always talk about net gearing, right? Net gearing
40%.
ratio, 40%. Right. So anything more than 40%, then red flag. But I prefer companies that are low in debt. But need to put into context also, because if it's low in debt and high cash, right, that means they are not deploying their money sufficient to. Yeah, so you just need to think about the company in context. Okay. Because if a company is highly leveraged, I mean, everything has two sides to it, right? If you can deploy your cash with borrowings and you can generate good returns, I think that's fine. But there are cases where companies are highly leveraged and then they fail eventually, which the possibility is quite high.
Yeah.
Yeah. So
correct.
need to put into context. Yeah. Okay, the last company, Alibaba. So yeah, for this one, I just want to talk about the free cash flow. So if you all remember, we are looking at ops activities, the net cash from ops minus the investing activities. So in this case, we look at the orange column, which is the 2024. So it's 182,593 minus 21,824. So what they have left is 160 billion renminbi. Okay, it is a cash-rich company. Okay, I repeat, 160 billion renminbi. It is a cash-rich company, but because of government controls,
Correct.
that's why their stock prices and other Chinese companies didn't fly, right?
Yeah.
So fundamentally, Alibaba is an excellent and cash-rich
Yep.
company, but it's just because it's subjected to government control. Okay, yeah. So this is something I just want to let you all know, and yeah, hope you all have a great time learning and hearing my sharing. Okay. At this point in time, any questions?
Thank you, Gary. Thank you very much for your explanation. It's very detailed and simple to
thank you.
understand. Thank you very much.